My presentation today is largely on challenging our thought process, the way we are operating, where we say that our roles as MFD is behavioral management. I think very honestly, a lot of us, okay, before I start, my views are generally very straightforward, so please don't get me wrong. Whatever you think is interesting here, take it back, forget everything else, right? But I'll tell you what I feel because I meet MFDs across the country, and there is a learning that I have around MFDs that I really want to share with you. And because I've been doing a lot of work in this space, I will share with you what I do. So I'm not only going to give you gyan around what is wrong, but I'm also going to give you a solution how you can really solve it. In my opinion, our jobs as MFD is behavioral management, yes, but that has to significantly go down, because going forward, only on behavioral management will not be able to take our businesses forward. Everybody since yesterday I've been hearing has been talking about how India is a great story, how equity has under penetration, how mutual funds are going to just skyrocket in the next 10 years. But my question to you is, along with everything that is happening in this space, which brings in a lot of interest in equity investment because India is doing well, or in mutual funds because the product is brilliant, the point is, are you and me going to grow at the same pace at which the industry is going to grow? Because there are challenges. You know about these challenges, but I'm still going to present these challenges to you the way I see these challenges. First, 9 out of 10 people, and again, please don't get me wrong, 9 out of 10 people that I meet in our business across the country, we are largely into transaction advisory. What do I mean when I say transaction advisory? Transaction advisory means that a client comes to us, tells us, I have 10 lakh rupees. You will select the top 4 funds that are most popular at that time, and those funds are given to the client, right? Now the point that I raised while I was on the panel, if you continuously keep doing this for 10 years, 12 years, 15 years, you would have sold 200, 300 schemes, and I can guarantee you, me, or anybody else doing this has no idea of what is happening in the client's portfolio, right? And now is the time that we will have to start looking at solutions of how to solve this, which I will come to. Second, in my opinion, service is no longer a moat. 10 years back, when a client would call you, you would send somebody across with the forms, get the signs, get the check. The client will say, I need capital gain statement. You will make sure that everything is available immediately at a fingertip. Today, thanks to technology, none of these things are a USP that you and I can talk about saying that I give very good service. If we still are saying this, in another 5 years, we will not be saying this. The technology is growing at that pace. So in my opinion, the first 2 things, transaction advisory and service, which we thought was our moat, is going away thanks to technology. The other 3 things you all already know. I'm not sure how big this problem is in Kerala, but I can tell you where I come from, which is Mumbai. Passive and direct is a big challenge. Last, which we've not appreciated so far, is that thanks to COVID, we have a lot of people now who've moved to direct equity, moved to products like small cases. Thanks to so much happening in this space, that in fixed income there are 100 products available, and to make things worse for us, the indexation went away. Of course, the industry is trying its best to come up with various kind of products to still offer those services, but these are pure challenges that at least I see in the metro that I come from. And which is why I feel that now, if we think that behavioral management is the job of an MFD, you would want to rethink this 5 years from today, because things are changing extremely fast. So what am I proposing to you and giving you a solution for is that between behavioral management and fund management, you will have to start creating a space for yourself where you are also now looking at the math and not just the chemistry. For people who've sat for sessions since the morning, you know what am I talking about, and I was talking to Ajit about it. I think this is exactly the space that you will have to start creating, because everybody, and specifically AMCs in this ecosystem, has been telling you that your job is chemistry, focus on chemistry, focus on behavioral management. Your job is not fund management, but there is space between fund management and behavioral management where you will have to up your game to face the challenges coming ahead. What am I talking about? I think for me as an MFD, my role is split into 3 parts. My first role, in my opinion, is to advise based on a plan and not do a transaction advisory. So even if somebody comes to me and tells me that I've got 10 lakh rupees, I think I should not go ahead and say these are the 4 funds which are good for you. I have to understand the client background, the past, client's present situation, and where does the client really want to go. So I can call it making a financial plan. So when you make an actual financial plan, then you are actually in a position to understand why and how should this 10 lakh rupees be invested. And I'm going to give you an example to make you understand what am I saying. Suppose if I tell you I'm an aggressive client, what's the asset allocation you will suggest to me? More equity or less equity? More equity. But please try and understand, you have to go a step forward. Suppose if I tell you I have 3 goals. One goal is 20 years from today, another goal is 10 years from today, and one more goal is 1 year from today. Let's say I'm the most aggressive client, but I only have 1 year for one of my goals. Would you recommend equity to me? That you will only understand when you make a plan and not do a transaction advisory. That's a basic example because I wanted to put my point across. So please understand, transaction advisory will have to change into making a plan and advising based on a plan, because every client will have a separate goal, time horizon, risk profile, and you will have to structure it basis that. Because if we continue to do transaction advisory, there are hundreds of apps today available which at a click of a button will give you 4 schemes to invest in, and that's more comfortable for the investor to do. Second, in my opinion, what a job is, and I'm going to give you a solution and I'm not going to just talk and run away. Second, in my opinion, this is where you can create a moat. Understanding how to do the math. And I believe a lot of y'all here, unfortunately, are time and again told that math is not your job. But trust me, that is your job, and that is what is going to help you excel in what you are doing. So getting the right portfolio made for the client that plays a role in any economic situation is the kind of work that you and I will have to start doing. How many of you all sat for Ramesh's session? Please raise your hand. Ramesh, White Oak. How many of you all sat? He spoke about value, momentum, growth. He said how large cap, mid cap, small cap will all keep moving. You don't know what will work. He said all of that, right? Brilliant presentation. How are you going to use this? Tough question, right? How many of you all said for Ajit's presentation, right? He said interest rate and inflation is what you should look at, and it's extremely simple. Yes or no? Tell me, how are you going to use this to create a portfolio? I'm going to give you a solution of both of these things in the next 3 slides. Pay attention. And I'm so glad that they presented before me. They cleared your basic. I can directly move on to the subject. Third is hand holding, which I'm not going to talk to you all about because you all are great at it. So I'm going to talk to you all about the first 2 things and help you understand how can you create a portfolio. Simple, right? But first, why should you make a financial plan? You should make a financial plan because how many of you all sell insurance? Right? The entire insurance industry works on one simple data point, apart from there is no liquidity, that if you do not continue this, you will not be able to reach your goal. Have you seen how they've structured their products? Retirement plan, child's education, child marriage. Goal is what sells because it brings discipline, and also once you make a plan, you can get a higher wallet share from the client. I'll tell you what I mean. Generally, when you and I go to a client, right, we typically ask the client, how much SIP do you want to do, sir? Right? The client says 10,000 rupees, we give 10,000 rupee worth of solution to the client. Trust me, I've been doing this for the last 15 years and I can guarantee you, the day you start making a plan, the same client will understand that in 15,000 nothing will happen. He'll have to do a 35,000 rupee SIP and he will give you that 35,000 rupee SIP. Making a plan will get you a higher wallet share, will make sure that the client is disciplined, like we've seen in insurance. She knows that if she breaks the SIP, she's not going to be able to reach her goal, right? And third, it'll help you give the right asset allocation for every goal. Now coming to the most interesting part that I really want to spend most of my time on is, how do you actually build a portfolio? So suppose if a client comes to you and you've done a plan, you know that the client wants to do a 50,000 rupee of SIP or wants to invest 10 lakh rupees lump sum. How do you decide which 4 schemes? I think that's a problem that a lot of us don't focus on. Okay, how many of you all think this is not your job? And 10 years later, all schemes will perform the same. So how does it matter whether I select a good scheme or a bad scheme? I know a lot of us think like that, right? We are also told that in a lot of AMC presentations, right? But I'm going to help you understand why that is your job and you should focus on it. I'm sorry, but there are 1,000 plus schemes, 1,500 schemes to be precise. I can tell you with all the confidence that even if there is a client which has 5 crore worth of portfolio, you don't need more than 4 or 5 schemes. The challenge is, if there are 1,500 schemes, how do you pick those 4 or 5? A bigger challenge is, how do you make sure that you continuously keep monitoring those 4 or 5 so that they are good for the longest time, and if they are not, you change it. How are you going to be able to do all of these things? What I do, 3 simple steps. But before I move there, to answer your question, does this even matter? Is it my job? Do I really have to care about getting the right scheme in place? Will my client make benefit of this? Is 5 year a good time horizon to talk about? Yes, no? In the last 5 years, the best performing small cap has generated 29.36% returns. The worst performing small cap has generated 15.48% return. The difference between the best and the worst is a staggering 14% CAGR in 5 years. That is going to be more than the capital invested 5 years back. Here is where you can bring a lot of value to your investors, because today that same investor is going away to save 1% in passive or direct. Are you all with me? Going away for 1%. The difference between good and bad is 14%. Mid cap, the difference between good and bad is 11%. Now if I tell you that if your client is going away for 1%, but if you can bridge this difference of 14 and 11, do you really think he'll go away for 1%? What should you do? What do I do? What's the simplest workable formula that you can actually use when you step out of this door? First, make sure that you decide on an asset allocation. You know what is the asset allocation you really want to offer to this client. First, always be sure when you meet the client that you know the asset allocation you want to offer this client. Second, have a scheme selection process in mind. Third, while everybody, and I remember Ramesh also made a point that don't look at macros, they don't look at macros. Ajit also made a point around macros. I can tell you, because you and I don't really have the skill sets to look at P&L, cash flow, balance sheets and monitor them quarter on quarter, the only thing that we can do to bridge the space between behavioral management and fund management is to understand a little bit of macros. And I'll tell you how it will solve your life. They are all friends, so I can very easily talk about them. They are not going to feel bad about it. First, asset allocation. Let's say I'm an aggressive investor. What is my asset allocation strategy? So if I'm an aggressive investor, I put 70% of my money in equity, 10% of my money in fixed income, and I have 20% of my money kept as tactical allocation. What do you understand when I say tactical allocation? I might change it once in 2-3 years depending on some triggers that I work myself around. But this 20% actually brings the alpha, and I'll show you how. Right? So if I'm aggressive, I'll have 70% equity, 10% fixed income, and 20% tactical, which I might change a little bit here and there depending on whatever little bit understanding I have. Okay? Now you might choose not to do 20% tactical at all, that's your call. But I can show you how you can do that 20% also without doing a lot of hard work at your end. How do I select 70% India equity portfolio? How do I select 70% India equity portfolio? Simple. Remember this, because this, in my opinion, will solve most of your problems. You remember Ramesh from White Oak, when he was doing the presentation, he showed you a slide saying that there are times where value works, there are times where momentum works, there are times where growth works, and nobody can predict what will work. Did he say that? Remember? Did he also show you a slide that there are times where large cap will work, there are times where mid cap will work, and then there are times where small cap will work and nobody can predict what will work? Do you all remember his presentation? Right? He's absolutely correct, and we want to use the same knowledge to build the portfolio. I don't know what will work. I don't know whether value will work. I don't know whether momentum will work. I don't know whether growth will work. I don't know whether large cap will work. I don't know whether small cap will work. I don't know whether mid cap will work. So build a portfolio which has all of these things. What do I mean? Pay attention. Like I said, you don't need more than 4-5 schemes, right? How do you bring these 4-5 schemes together? Make sure that in these 4-5 schemes that you bring together, you have a good spread for all three. Have value, have momentum, have growth. What is value? Now you will say, how do I understand which scheme is value? How do you understand which scheme is value? Yeah, because this is what Ramesh said, and I am hoping that you all want to take this back home. So you will have to understand what is value. What do you understand when I say in 4-5 schemes, have one scheme which is value? What is value? So, if you talk to more and more AMCs, you will understand that they follow value strategy. Like ICICI follows value strategy. HDFC follows value strategy. So when you talk to AMCs, you will understand that there are AMCs who follow one style of investing. Right? What is growth? So what is value? Value means they will try and buy stocks cheaper than what they think is the fair value. So if they think that the fair value of the stock is 100, they will only buy the stock if the stock is available at 90. They will not buy it at 110. That's value style of investing. Everybody with me? What is growth? Growth, because Axis is here, I'll take Axis's name. Axis follows growth strategy. What is growth? The stock's fair value may be 100. It is trading at 110. You will still buy it at 110 because you are assuming that the company earnings are going to be so good that 110 is also a fair price and it will move over and above 110 from here also. Are you all with me? Now there are economic situations where value works. There are economic situations where growth works. Nobody knows what will work. But 10 years later, you will understand that both did decently well. Have both in your portfolio. Are you all with me? First exercise you have to do is figure out AMCs which are growth, figure out AMCs which are value, and figure out AMCs which are momentum. Once you break this down, you know what falls in which bucket. And while you are trying to bring 4 or 5 schemes together, you know you need 1 or 2 from each one of them. Everybody with me? Yes, no? Yes. Second, make sure that you invest across all 3 market caps. Do large cap, do mid cap, do small cap. Instead of large cap, you might choose to do flexi cap. That's okay. It's a pseudo large cap. Only the name is different. So you do a flexi cap for large cap, you do a mid cap, you do a small cap. When you bring all 3 together, you don't really have to worry about which will work the next 3 months or 3 years. Whatever works, you have that in the portfolio. It brings a balance to your portfolio. Are you all with me, everybody? Right? So ideally what you do is 4 or 5 schemes. Make sure that you have value, momentum, growth. You have large cap, mid cap, small cap, all 3. If I have to give you data for the last 20 years, a equal weighted portfolio of large, mid, small, 33 in large, 33 in mid, 33 in small, has had a standard deviation or risk equivalent to Nifty and returns 2% higher than Nifty 500. In simple language, a equal weighted portfolio of large, mid, small has risk equal to large cap and has return equal to mid cap. Does that help? So while you do large, mid, small, you will take risk of large cap, returns of mid cap. So 4 or 5 schemes, make sure it's spread across value, growth, momentum, have large cap, mid cap, small cap, your problem will be solved. How do you choose? Because I'm running short of time, I'll have to hurry up a little. How do you choose which 2, 3 funds or 1 fund should I take in value? How do you choose which 1 or 2 funds should I take in growth? While I do a lot of things, to give you an understanding, there are 4 data points that you can look at. 4 data points. First, never look at the last 3-year, 5-year, 7-year, 10-year, 12-year performance. It's the worst thing that you will do. Why? Let me help you understand. Let's say if one scheme in the last year has generated 30% returns, you will automatically see 3-year, 5-year, 7-year, 10-year, all data showing you that the scheme has done brilliantly well. Why? Because in 3 years you have last 1 year, in 5 years you have last 1 year, in 7 years you have last 1 year, and in 10 years you have last 1 year. See, the last 1 year is good. Suddenly you will start feeling that the fund is doing exceptionally well over the last 10 years, but that might not be the case. Same. If the scheme has fallen 20% in the last 1 year, suddenly 3 year, 5 year, 7 year, 10 years since inception, everything will look bad. The only way, at least at our level, to understand if the fund is consistent or not is you look at rolling returns. You look at the 3-year rolling return over the last 10 years, compare it with the benchmark, and you will know whether the scheme has consistently performed or not. For people who don't know rolling returns, very quickly, if the 3-year rolling return for 10 years, and it's available for free on all websites, shows you 12%, that means that in the last 10 years, had I invested at any point in time, but had I stayed invested for 3 years, the fund would have given me 12% returns. Are you all with me? Only looking at the return or consistency may not solve your problem. So you also look at risk. Risk adjusted return. Sorry, I'm running short of time, so I'll not spend a lot of time here. But make sure you look at Sortino ratio. Make sure that that is better than the index average. Look at the fund's alpha and make sure it is over 0, more than 0. And the last thing you look at is the down capture ratio. I'll spend 1 minute here. What's a down capture ratio? It tells you that when the markets were falling, did your scheme fall less than the market or not? Would everybody agree that you want to invest in a scheme when the market falls, your scheme falls less? How do you understand that data? Down capture ratio. Available on all websites for free. Right? So find a scheme whose down capture ratio is less than 100. Less than 100 means that if the market fell by 100 units, it fell less than 100 units. So, very quick summarization, 4-5 schemes, you don't need more than that. Make sure you have value, growth, momentum. Make sure you have large cap, mid cap, small cap. And make sure that while you are selecting these schemes, you look at these 4 data points, freely available on all websites. There is one noteworthy thing. I have done rolling returns on 10 years. I have done Sotino and Alpha on 3 years. And I have done down capture at 5 years, so that you can cover near term, mid term and long term, all 3. Equity, clear everybody? Okay. Okay. What do you do in debt? Now again, my idea may not sync with everybody, but I can tell you Franklin Templeton was one of. Do not get scared. Like value and momentum and growth works in cycles, you have credit risk funds and duration funds working in cycles. So if you understand macroeconomics, you will know when will credit work and when will duration work. But if you don't know, have both in the portfolio. Right? Just try and make sure that when you're putting the schemes together, or which scheme do you want in credit and which scheme do you want in duration, make sure that you look at low concentration risk, low sector risk and higher AUM. Make sure that the debt fund has high AUM and the debt fund does not give a lot of money to one company or a lot of money to one sector. You do just these 3 things and 9 out of 10 times you won't have a problem in fixed income at all. Now, here's the best part, and I'm running out of time, but you remember I told you there is 20% tactical also that you can do. What is tactical? This is just for your understanding. I'm trying to help you understand when does value work, when does growth work. So when does value work? If you have 20% more money to invest and you are confused, should I put it in value or should I put it in growth? You know the answer. When does value work? Try and understand. Let's say if I tell you markets are extremely expensive right now. Extremely expensive. You have one stock which is available cheap. You have one stock which is available expensive. Which one will you buy? Cheap or expensive? Cheap. So in expensive markets, value strategy works. That is where you should put your money. Suppose if I tell you that markets are extremely cheaply available, but there is one company which is going to grow slow, and then there is one company which is going to grow fast. Which one will you buy? Growth. So when markets are cheap, invest money in growth. Simple. And fund managers will tell you whether markets are cheap or expensive. When they say markets are looking expensive, you know value style will work. When they say markets are looking cheap, you know growth style will work. With me, everybody? Right? Debt. Forget about this. You may click a photograph, but I'm going to make your life extremely simple. How many of you all know that when interest rate falls, value of debt goes up? Ajit spoke about it, right? He spoke in Malayalam, but I believe I understood he spoke about it. Right? So today, what do you think, interest rates are going to fall or go up over the next 3 years? Fall. So should you do short duration or long duration? Long duration, simple. So when interest rates are supposed to fall, do long duration. But what do you do when interest rates are supposed to go up? Credit. Credit. Why? Because the companies, even if they are the worst of the companies, they've been able to raise money from the market at a cheaper rate. So the probability of them defaulting is much lower. Simple. So when markets are expensive, you do value style. When markets are cheap, you do growth style in equity. When interest rates are high, you do in debt. What do? Duration. When interest rates are low, credit. Simple. This is how the markets function. One last slide because I'm running out of time. When does gold work? And these are lifelong learnings. You can challenge me on this whenever you meet me 20 years later also. This is how it will function. Unless there is a war and something happens, you can't put economics there. When does gold work? Right? Now there is a confusion here because I am talking in terms of rupee and the other guest was talking in terms of dollar, but you don't confuse, I'll explain to you. Let's say interest rate is at 6%. Inflation is at 7%. Right? Are you making money or losing money? Will you want to do fixed income? No. So people who don't want to take a lot of risk and fixed income is not an option. Where does that money go? Gold. So gold works when the real rates are negative. Interest rate 6, inflation 7. You call this as negative real rates. Gold works then. And gold also works when the rupee depreciates. Why? You import $1 of gold for 80 rupees. Let's say $1 becomes 85 rupees. What happens to your gold price? Go up. 80 becomes 85. So gold works in these two scenarios. There is nothing outside of this that you and I need to know because we are not trying to be fund managers. We want to be somewhere in between. Last slide. So suppose if I have to use this, whatever I shared with you as of today, what do? I am saying I have to put 70% in equity. So I'll put 20% in large cap or flexi cap. I'll put 25% in mid cap and 25% in small cap. But I'll make sure that it is spread across value, growth and momentum. Right? Where do I put my fixed income? 5% in credit, 5% in medium duration. Because it has to work in all cycles. Rates going up or rates going down. Where do I do my tactical? I will do in gold and long duration. Long duration, why? Because I'm expecting interest rates to fall. Gold, why? Because I am assuming that the real rates in the country will fall. When interest rates will start falling, money will move out of fixed income and go to gold. Simple. You continue to do that and there is no problem that, in my opinion at least, that you will face. Make sure that you identify 20 schemes. Just identify 20 schemes and make sure that at all points in time, all your clients' money is only in those 20 schemes. Only then you will be able to track those 20 schemes and make or advise changes. While I had a lot of other slides, I'll have to stop here because I'm running out of time. But I hope I made sense. Thank you so much for all your time. You all were a great audience.